And say, in investing, there are successful people, and then there are anomalies. People who operate so far outside the normal rules of the game that even professionals struggle to explain what they are seeing. Michael Steinhardt was one of those anomalies. If you had invested $10,000 with him in 1967, by the late 1980s, you would have had more than $1 million. Not from a lucky trade, not from a bull market, and certainly not from buying and forgetting. This was active management, aggressive management, sometimes brutal management, the kind that made fortunes quickly and occasionally lost them just as dramatically. Steinhardt wasn't the calm grandfatherly investor patiently sipping Coca-Cola while reading annual reports. He wasn't Warren Buffett. He wasn't Peter Lynch. He was a predator, a trader who treated markets like combat. And perhaps the strangest thing about his success was this: he did not rely heavily on traditional Wall Street research. No giant stacks of reports. No armies of analysts building discounted cash flow models. No elegant theories about efficient markets. Instead, he built his edge from instinct, speed, psychology, intensity, and a near-obsessive understanding of how crowds behave under pressure. Today, we're going to explore the mind of Michael Steinhardt. Not just the trades, not just the returns, but the philosophy, the psychology, and the uncomfortable truths about markets that most investors would prefer not to hear. Because buried inside Steinhardt's methods is a larger question. What actually creates an edge in financial markets? And why do so few people possess one? To answer that question properly, we need to understand the world Steinhardt operated in. This was not modern Wall Street. There were no smartphones, no Reddit traders, no commissioner-free apps encouraging millions of people to gamble from their bedroom. This was an era of cigarette smoke, screaming brokers, paper tickets, and information moving unevenly through tightly connected networks of institutions. If you had an informational edge in those days, it mattered enormously. And if you had the courage to act on that edge aggressively, the rewards could be spectacular. Steinhardt understood that earlier than most. He recognized that markets were not tidy mathematical systems. They were battlefields of perception. And the winners were often not the people with the highest IQs. They were the people who reacted fastest under uncertainty. That distinction would define his entire career. In investing, there are successful people. And then there are anomalies. People who operate so far outside the normal rules of the game that even professionals struggle to explain what they are seeing. Michael Steinhardt was one of those anomalies. If you had invested $10,000 with him in 1967, by the late 1980s, you would have had more than $1 million. Not from a lucky trade, not from a bull market, and certainly not from buying and forgetting. This was active management, aggressive management, sometimes brutal management, the kind that made fortunes quickly and occasionally lost them just as dramatically. Steinhardt wasn't the calm grandfatherly investor patiently sipping Coca-Cola while reading annual reports. He wasn't Warren Buffett. He wasn't Peter Lynch. He was a predator, a trader who treated markets like combat. And perhaps the strangest thing about his success was this: he did not rely heavily on traditional Wall Street research. No giant stacks of reports. No armies of analysts building discounted cash flow models. No elegant theories about efficient markets. Instead, he built his edge from instinct, speed, psychology, intensity, and a near-obsessive understanding of how crowds behave under pressure. Today, we're going to explore the mind of Michael Steinhardt. Not just the trades, not just the returns, but the philosophy, the psychology, and the uncomfortable truths about markets that most investors would prefer not to hear. Because buried inside Steinhardt's methods is a larger question. What actually creates an edge in financial markets? And why do so few people possess one? The man who made Wall Street nervous. The pages we're examining today describe Michael Steinhardt as one of the greatest investors of his era. Wow. That's not hyperbole. Over roughly 2 decades, Steinhardt produced annual compounded returns of around 24% after fees. That is an astonishing number. To appreciate how extraordinary this is, remember that compounding is brutally mathematical. A small difference in annual returns becomes enormous over time. 24% compounded over decades transforms ordinary sums into generational wealth. But there was another detail that fascinated people. Steinhardt charged massive commissions. The text describes him paying roughly $35 million annually in commissions to Wall Street brokers. Now, that may sound outrageous. But in the ecosystem of Wall Street, commissions buy something very valuable: information, access, speed, ideas, and perhaps most importantly, relationships. Steinhardt understood something many investors still fail to appreciate. Markets are social systems. Prices move because human beings react, and information does not spread evenly. Some people know things sooner. Some people interpret things faster. And some people are simply more aggressive in acting on incomplete information. Steinhardt belonged firmly in the third category. He wanted tiny informational advantages, tiny psychological advantages, tiny timing advantages, not certainty. Most amateurs imagine successful investing as possessing superior certainty. Professionals know the reality is usually much messier. You rarely know. You infer. You estimate. You anticipate. And then you act before everyone else becomes comfortable. That's what made Steinhardt dangerous. He was willing to move aggressively while others were still hesitating. The limits of research. There's a subtle but powerful criticism embedded in these pages. The author notes that Wall Street research often projects current trends years into the future. And this remains true today. Financial institutions produce endless reports filled with charts, assumptions, growth estimates, and target prices. The problem is not that these reports are useless. The problem is that they often encourage a dangerous illusion of precision. Markets are not physics. They are emotional ecosystems filled with fear, greed, narrative, politics, leverage, incentives, and crowd psychology. Steinhardt understood this intuitively. He was skeptical of rigid forecasting because markets change direction precisely when consensus becomes comfortable. This is one of the deepest truths in investing. The future is rarely obvious in advance. But once it becomes obvious, the opportunity is usually gone. Steinhardt looked for dislocations, moments where perception and reality diverged. And importantly, he was willing to act quickly. Very quickly. The pages describe Steinhardt as someone searching for a tiny edge across innumerable opportunities. That phrase matters. Because investing legends are often portrayed as prophets making grand predictions. In reality, many successful traders operate through accumulation. Small advantages. Repeated consistently. Executed aggressively. Like a casino. A casino doesn't need certainty on every hand. It merely needs favorable odds over time. Steinhardt approached markets similarly. And this mindset separates traders from storytellers. The storyteller wants to sound intelligent. The trader wants to survive. The cult of prediction. The text suggests that Steinhardt did not buy research for prediction. He bought it because he hoped it might provide a slight edge. This is psychologically sophisticated. Most people desperately want certainty. They want experts to tell them exactly what will happen. But elite traders often think probabilistically instead. They ask, Boyle, what are the odds? What information does the crowd not fully appreciate? What happens if expectations are wrong? This is a fundamentally different way of thinking. And frankly, it's uncomfortable. Because probabilistic thinking forces you to admit uncertainty. You can be right and lose money. You can be wrong and make money. A good process does not guarantee immediate results. This creates enormous emotional pressure. Most people cannot tolerate it, which is one reason markets remain inefficient. Steinhardt's edge wasn't simply intelligence. His edge was psychological. He was willing to operate in ambiguity. He could make decisions before consensus formed. And importantly, he could reverse course quickly when conditions changed. Steinhardt, the strategic trader. The chapter repeatedly refers to Steinhardt as a strategic trader. That phrase deserves attention. because it distinguishes him from traditional investors. A strategic trader is not merely buying good companies. A strategic trader is attempting to anticipate movements in capital. This includes economic shifts, political changes, interest rate expectations, currency movements, institutional positioning, and crowd psychology. Steinhardt reportedly developed views on markets very rapidly. He consumed information aggressively, then acted. One of the fascinating tensions in his philosophy is the balance between conviction and flexibility. You need conviction to enter large positions, but you need flexibility to survive. Too much conviction becomes stubbornness. Too much flexibility becomes paralysis. Elite traders somehow operate in the narrow space between the two. Steinhardt appears to have mastered that balance for long periods. The role of temperament. One of the most important lessons from Steinhardt's story has nothing to do with finance. It has to do with temperament. Most investing books focus obsessively on analysis, balance sheets, valuation models, economic indicators. But professional investing is often more psychological than analytical. Can you tolerate uncertainty? Can you endure losses without panicking? Can you maintain discipline while others become euphoric? Can you act aggressively when opportunities appear? And perhaps hardest of all, can you change your mind? Steinhardt appears to have possessed an unusually high tolerance for discomfort. That matters enormously, because markets constantly generate emotional pain. When prices fall, fear dominates. When prices rise, greed dominates. Most investors are emotional trend followers. Professional traders attempt to exploit this behavior, not because they are emotionless, but because they recognize emotional extremes in others. This is one reason many great traders appear psychologically unusual. They are often restless people, competitive people, people who are uncomfortable standing still. The emotional wiring that helps someone survive in highly competitive markets is often the same wiring that makes ordinary life difficult. Many elite investors become obsessed with information. They constantly monitor sentiment. They replay decisions in their minds. They worry about risks that other people don't even notice. And they become hyper-aware of changes in narrative. Steinhardt appears to have belonged firmly in this category. He was not simply participating in markets. He was immersed in them. This intensity is difficult to fake, and it may explain why so few people replicate extraordinary investment performance. Most people do not actually want to think about markets all day. They want the rewards without the obsession. But markets are brutally competitive arenas. The participants managing billions of dollars are intelligent, ambitious, and highly motivated. Competing successfully against them requires more than casual interest. It requires emotional commitment. And emotional commitment creates psychological cost. This is something financial media rarely discusses. The image of the successful investor is often glamorous. Private jets, expensive suits, prestige. But the internal reality can be very different. Stress, self-doubt, isolation, constant uncertainty. The pressure of knowing that a single bad decision can erase years of gains. Professional trading can become emotionally exhausting precisely because outcomes are never fully controllable. Even brilliant analysis can fail. Unexpected political events can change markets overnight. Central banks can reverse sentiment instantly. Crowds can behave irrationally far longer than logic would suggest. This creates a strange emotional paradox. The more deeply you understand markets, the more aware you become of uncertainty. And yet, you still must act. That's what makes great traders psychologically different from spectators. Spectators can remain intellectually detached. Traders cannot. Their ideas are connected to real money, real consequences, real reputational risk. And that pressure changes behavior. Steinhardt appears to have thrived under that pressure for long periods, but thriving under pressure is not the same as being comfortable. Many elite performers become addicted to intensity. Normal life begins to feel too slow, too predictable, too emotionally flat. Markets provide constant stimulation, constant competition, constant feedback. And for certain personalities, that environment becomes irresistible. which may explain why some investors continue trading long after they have already accumulated more money than they could ever reasonably spend. At that point, the activity is no longer purely financial. It becomes psychological, a competition, an identity, perhaps even a form of meaning. Steinhardt's story hints repeatedly at this deeper relationship between personality and performance. He was not simply using a strategy. In many ways, he embodied the strategy. And that is a much harder thing to replicate. Why most investors fail. One of the most important lessons from Steinhardt's story has nothing to do with finance. It has to do with temperament. Most investing books focus obsessively on analysis. But professional investing is often more psychological than analytical. Can you tolerate uncertainty? Can you endure losses without panicking? Can you maintain discipline while others become euphoric? Can you act aggressively when opportunities appear? And perhaps hardest of all, can you change your mind? Steinhardt appears to have possessed an unusually high tolerance for discomfort. That matters enormously, because markets constantly generate emotional pain. When prices fall, fear dominates. When prices rise, greed dominates. Most investors are emotional trend followers. Professional traders attempt to exploit this behavior, not because they are emotionless, but because they recognize emotional extremes in others. Why most investors fail. Very few people actually want to invest the way successful investors operate. People say they want high returns, but they often do not want volatility, uncertainty, stress, criticism, temporary losses, or emotional discomfort. And unfortunately, those things are usually inseparable from superior returns. Steinhardt understood this. He was willing to look wrong temporarily. Markets often punish correct positions before rewarding them. If your time horizon is too short, or your emotional resilience too weak, you may abandon good trades prematurely. Conformity is extremely dangerous in markets, because if everyone already agrees with you, the price usually reflects that agreement. Steinhardt's willingness to diverge from consensus was one of his greatest strengths. The psychology of edge. The pages repeatedly return to a fascinating concept. Edge. Not certainty. Edge. An edge can be tiny. A slight informational advantage. A behavioral advantage. A speed advantage. A structural advantage. A psychological advantage. And when applied repeatedly over thousands of decisions, tiny edges become enormous fortunes. Humans naturally seek dramatic explanations. We want a secret formula, a genius prediction. But financial success is often disturbingly incremental. Steinhardt wasn't searching for perfection. He was searching for asymmetry. Situations where the potential reward outweighed the risk. And importantly, he moved decisively when he found them. The dangers of success. Success creates its own hazards. And Steinhardt's career illustrates this beautifully. When investors succeed repeatedly, they can begin to believe their own mythology. This is dangerous. Markets have a brutal way of humiliating certainty. The pages hint at Steinhardt's confidence, and at times, his aggressiveness. Those qualities fueled his success, but they also increased the potential for catastrophic error. This is one reason many great traders eventually struggle. The very traits that create extraordinary returns can become liabilities under different conditions. Aggression becomes recklessness. Conviction becomes rigidity. Confidence becomes overconfidence. Financial history is full of brilliant people, destroyed by their inability to adapt. What made Steinhardt different? So what exactly made Michael Steinhardt different? The pages suggest several possibilities. First, intensity. Second, flexibility. Third, skepticism. Fourth, speed. And finally, perhaps most importantly, he understood the importance of psychology. Not just his own psychology, everyone else's. Markets are collective emotional system. Fear spreads. Optimism spreads. Narratives spread. And traders who understand crowd behavior possess a major advantage. Stories like Steinhardt's remain fascinating because they reveal the outer limits of what active management can sometimes achieve. Not safely, not peacefully, not consistently forever, but spectacularly. The bigger lesson. There is a deeper lesson running underneath these pages. Financial markets reward behavior that feels psychologically unnatural. Patience during panic. Skepticism during euphoria. Discipline during uncertainty. Most people struggle with these behaviors because human beings evolved for social survival. Conformity kept our ancestors alive. But in markets, excessive conformity becomes expensive. Steinhardt's success came partly from his willingness to think differently. But thinking differently alone is not enough. You also need execution, timing, risk management, emotional control, and an unusual tolerance for discomfort. This is why extraordinary investors remain rare. The barriers are not merely intellectual. They are psychological. The market is not simply a test of intelligence. It is a test of character. Ending. Michael Steinhardt built one of the most extraordinary investment records of his generation. He did it through aggression, speed, flexibility, psychological insight, and an unrelenting search for edge. But perhaps the most interesting thing about his story is this. He reminds us that markets are profoundly human. Behind every chart is fear. Behind every rally is hope. Behind every crash is panic. And the investors who understand human behavior most deeply often understand markets best. Steinhardt was not merely analyzing companies. He was analyzing people. And on Wall Street, that can be a very profitable skill. Thank you for listening.